All right, so today on Retirement Crusaders, I want to talk about why bond funds are for suckers. Okay, so let's dig into this topic. You want to never buy bond funds. They're great for Wall Street, they're great for your broker, they're terrible for you. Bond funds are touted as diversification from stocks. So that the idea is when stocks go down, your bonds will be stable or go up, but that doesn't work. In fact, right now, as I record this in October of 2022, both your stock funds are down and your bond funds are down at the same time. They've provided no diversification benefit for you. Now, we'll also show you why individual bonds versus bond funds, huge difference night and day, and why you should buy individual bonds and never bond funds. Now, let's do a review so we just start from the same place. Bonds are issued by entities, corporations, governments, municipalities. Basically, they're borrowing money from you, the investor. So they issue a security, they take your money, and then they make a promise to you about paying you back that money. And the promise is they will give you a fixed interest rate for the term of the bond. And bonds come in all different terms, 1 year, 5 year, 10 year, 15, 20, 30. Okay. So you get to choose what bonds you buy. So you get to pick the term. But no matter what the term is, the interest rate for that entire term is fixed. It doesn't change. And most bonds pay interest every 6 months. So every 6 months you get the same check like clockwork. You know exactly what you'll get. The other thing is at maturity, so if it's a 10-year bond, in 10 years, you get back the face value of the bond. So bonds are typically sold in $1,000 denominations. Let's say you buy 10 bonds, you invest 10,000. You know at the end of 10 years, you will get back $10,000. It won't be 10,001, it won't be 99,000. It's going to be exactly what the face value of the bond is. So that is the beauty of individual bonds, is that everything is known. The interest rate is known, and what you're going to get back is known. Now, keep that in mind as we talk about bond funds. The problem, as we'll see in a minute, is that with bond funds, you have no guarantees. Now, before we go on and talk about bond funds, we need to understand one other feature of bonds. Bonds will fall in value when interest rates rise. Let me give you an example. Let's say today I want to buy a high-grade corporate bond, a 10-year bond, and let's just say the market rates for that are 5%. So I go and invest my $10,000, and I've locked in 5% now for the next 10 years. But if next year interest rates go up, let's say they're 6%, a new investor next year would say, oh, I want to buy a 10-year high-grade corporate bond. And he would look and see, oh, I can go get 6%. I'm here holding a bond that's paying 5%. So if I want to sell my bond in the open market, that investor, he's not going to pay me $10,000 because he can go buy a new bond at 6% for $10,000. If mine only pays 5% because it's a fixed interest rate, he'll say, you know what, Larry, I'll buy that bond from you, but I'm not going to pay you $10,000. I'll give you $9,700 for it. So as we see, if you're holding a bond and interest rates rise, the bond will fall in value if you decide to sell it. But as you'll see, the key to owning bonds is to always, always, always hold them to maturity. Now, the opposite also happens. Bonds will rise in value when interest rates fall. Because if I have this bond at 5% and next year a new investor goes to buy a bond and he sees the rates are only 4%, he might say, you know what, Larry, for that $10,000 bond you have that's paying 5%, I'll give you $10,300. So my bond will have gone up in value if I chose to sell it on the open market. Okay, now, these two facts do not matter when you hold your bonds to maturity, because if you buy a bond for $10,000 at maturity, you're going to get face value 10,000. So who cares if your bond goes up and down in value? That's the beauty of individual bonds. It doesn't matter what happens if you hold it to maturity. So let's just look at a visual example. You buy a bond that's a 10-year bond. In year one, you buy the bond, and the bond value during that 10 years is going to go up and down. It'll fluctuate as interest rates change. But who cares? Because you're going to buy the bond for 10,000, you're going to hold it to maturity, and you're going to get 10,000. You don't care what happens during the term of the bond because you hold it to maturity, and you're going to get, if you started at 6%, you're going to get 6% the whole way through. This is the beauty of bonds, fixed interest rate, and you have a guaranteed payoff. Now, what happens when you put bonds into a fund? This is where the problems start. Each bond in the fund, see, the fund now holds 100 bonds, 200 bonds, 300 bonds. Each bond in the fund has a different interest rate. One has 5% interest rate. Another one's 5.5, another one's 4.75. A different bonds get 6%. So it's this whole big basket of bonds with different interest rates. And the bond fund, whatever that average interest rate is, that's the dividend that the bond fund pays to you, whatever the average of that whole mixture is. Okay. But wait, it gets a little more confusing. And then each bond in the fund has a different maturity. Maybe one bond matures in 10 years, another one matures in 12, another one matures in 15. So when do you get your money back? What is the maturity date? There is no maturity date with the bond fund. So the whole idea of individual bonds, the beauty that you always get face value at maturity, forget about that with bond funds. You have no guaranteed payoff. You're going to get whatever you get on the day you decide to sell your shares in the bond fund. No guarantees. You might make money, you might lose money. Okay. Now, during the time you own the bond fund, the portfolio of the bonds in that fund keep changing. The bond fund manager is always buying and selling bonds, and he's forced to do that, as I'll explain in just a minute. So what happens is, not only is that dividend that you're getting when you first invested in the bond fund a certain amount, but that's going to change. Why? Because the bond fund manager keeps changing what's in the fund. So if you were getting a dividend of 5% when you first invested in the fund, you may find that month 2 or 3 or 4, whenever, if you get a monthly dividend, that dividend may change. Okay, not fixed. The bond fund's always changing its contents. Now, so the results of this are as follows. You've got no fixed interest rate. You've got no fixed maturity date. And this is even worse. That dividend you start with will never, ever, ever go up. Not possible. Now, this may surprise you because you say, well, wait a minute. If interest rates go up, won't I get more? No. Here's why. I need you to think about yourself as the bond fund manager. Now, here's what your job is as the bond fund manager. There's this portfolio of bonds. You step into the job. It's already an existing fund. You have this portfolio of bonds, 300 bonds. It's your job to manage them. Now, what happens is each day when you come to work, one of two things happens. Either you open your mail and it's all these new investors who were investing their money, they want to invest in your fund. So if that's happening, your job is to take those checks and go buy new bonds. That's what these people are paying you to do. But take yours of cash, buy more bonds for the bond fund. Or the opposite could be happening. You may open your mail and a lot of people are saying, I want my money out. I want my cash. Well, where do you get the cash? You sell some of the bonds in that portfolio to get cash, and you send people out their cash. So that's your job. It's either to invest money as it's coming in or redeem bonds and pay people if they want their money back. Now, when does the bond fund manager get checks in the mail so he can buy new bonds? There's only one time when he gets checks in the mail. Usually when the bond fund is rising in value and interest rates are falling. Why is it that people want to invest in a bond fund when interest rates are falling? Well, two reasons. Excuse me. They're looking at their rates at the bank and the CDs, and they had the CD at 4%, and then it matured, and the bank said, "Well, we can only give you 3." So people are, kind of getting disturbed because interest rates are falling. But they look at in the internet, and they see this bond fund, the XYZ bond fund, as interest rates were falling. They saw the bond fund was going up in value because As interest rates fall, bond funds go up in value. So they think, wow, this might be a good fund to invest in. It's going up in value. Also, they see that, hey, my CD dropped to 3%. That bond fund is still paying 4.5%. So, because bond funds will lag the market. So they decide, well, it's going up in value, it's paying more, I'm going to invest in the bond fund. So when interest rates are falling, people send checks to the bond fund manager. What does the bond fund manager do? He takes these checks and he has to go out and buy new bonds. But the bonds in the fund that are there right now average 4.5%. Now with this new cash, he has to go out and buy bonds at 4% or 3.5% because interest rates are falling. So he starts adding new bonds to the fund. And as he adds these bonds at a lower interest rate, the average interest rate on the fund falls. And he has to reduce the monthly dividend that the bond shareholders get. So what happens in the opposite case when interest rates are rising? Well, the bond fund manager never has new cash to invest when interest rates are rising. Why? Because when interest rates are rising, people are looking at the XYZ fund on the internet and they see, oh, it's falling in value. Now, you tell me, do most people in America invest in things when it's going down in value? No, people buy when they see things going up. So the bond fund manager is not getting any fresh cash into the bond fund when interest rates are rising. That's exactly when he would like to have fresh cash, because then he could buy new bonds at higher rates and raise the dividend that the fund can pay. But he never has new cash at that time to do it. So in all the years I was a financial advisor, I never, ever saw a bond fund increase its dividend. All I saw was decreases. In fact, I'd like you to write in the comments if you've ever had a bond fund that increased the dividend, because it will be the first time in my lifetime I've ever seen that, and I'll hunt to investigate how that could possibly happen. Okay, so, and by the way, if you like this so far and you like videos like this, hit the subscribe button and a little bell icon so you get notified every time we post a new video. Now, let's go a little further. So, as we say, the bond fund manager gets fresh cash, new investors when interest rates are falling. The bond manager is forced to invest the fresh cash in new bonds as interest rates are going down. Now, this is not new information I'm telling you. In 1998, Time magazine had an article about this, and it wasn't new then. This was true in 1968. And they said, you know, these differences between individual bonds and bond funds are so fundamental that it's a stretch to even call them bond funds. They're more like a stock. Why? Because when interest rates go up, they're going to fall in value. When interest rates are down, go rise in value. You're not going to get any guarantee at maturity. You're not going to get a fixed rate. It's like basically buying a stock in a company that happens to invest in bonds. So this idea that bonds are diversification of stocks is purely nonsense. That's somebody's good idea, but it doesn't really work that way. They go on further to say, clearly, investors seeking to preserve capital and earn a fixed income stream for a set period of time have no business flirting with such a beast. Okay, oops, sorry about that. So, and by the way, on that last slide, let me see if I can go back. There we go. Have no business flirting with such a beast. They should go for individual bonds. Yet bond funds are routinely marketed and accepted as apt substitutes. And by the way, here's, if you want to read this whole article, here it is. It's still online, even though this was published in 1998. Now, you might say, hey, my financial advisor sold me this bond fund. He told me it's good. Listen, I don't know that I can blame your financial advisor. I'm not saying he did a bad thing. There's an 80% chance he just doesn't know any better. You know, look, to become a financial advisor in the United States, they have to pass an exam that any sixth grader, an intelligent sixth grader, could pass. It's a multiple choice exam. You study this one book and you take a multiple choice exam, and any intelligent 12-year-old could pass that exam. So I can't blame your financial advisor, because he may be a well-meaning, very nice person, wants to do the best by you, but he doesn't know any better. He doesn't have the education to understand what you're learning today. Okay, so let's summarize some things. Bond funds are not the same as individual bonds. Bond funds do not provide diversification of stocks when interest rates rise because right now in October of 2022, your bond funds are down and your stock funds are down, and diversification would mean that one should kind of offset the other. Doesn't happen. Bond funds can never increase their dividends, only decrease their dividends. So now you are a much wiser investor because you know that bond funds are good for Wall Street, good for your broker, bad for you. Please hit the subscribe button. See our next video. We'll see you next time on Retirement Crusaders with some more investing advice to give you a better retirement. See you soon.